If you've opened a stocks and shares ISA and you're not quite sure what to do next, or not sure if you've picked the right approach for your investments, this is for you. Investing ISAs have a really important part to play in long-term saving in the UK. This is even more so now because of a big tax change coming through from the government. For April 2027, the cash ISA allowance for under 65 is falling from £20,000 to £12,000 a year. The total allowance is going to stay at 20, so £8,000 a year has to go somewhere that is not cash. So the two questions that we're going to be answering today on the podcast: how do you pick what to invest in? And crucially, what are people actually buying? So to do that, I am joined by a really interesting guest today. Andy Prosser is Head of Investments at InvestEngine. Andy, welcome to the podcast.
Thank you for having me.
It's really great to have you on, especially because today we are going to be talking about this kind of dilemma with investing, particularly for people who maybe want to start that journey, have opened their investment ISA, are thinking about doing that, but aren't quite sure where to start, where to go next with that. Maybe they've made some choices and they aren't kind of sure whether that was the right thing. I know InvestEngine has lots of really interesting data on this as well. And we are going to be looking at some of that a little bit later on, just to give an idea of what people on the InvestEngine platform are doing with their investment ISAs, to give people a little bit of an idea. But just to go back to that point I made at the start about the cash ISA. Now, this is a bit of a kind of a topical reason why investing is actually becoming a bit more of an interesting issue at the moment. We all know that people in the UK don't necessarily invest enough. The government worries that there is too much being held effectively in cash ISAs. And that's part of the reason why they're bringing in that little change, isn't it? It's to kind of encourage a bit more of that investment mentality, I guess. Would that be right?
No, 100%. And I think like the first thing to think about when you think about these changes are the differences between saving and investing, because sometimes they're kind of confused a little bit, especially when you talk about savings plans and that sort of thing, but they do fundamentally different jobs, right? So saving, keeping your money in cash, really useful for money that you need soon, i.e. you're building up an emergency fund, you've got a house deposit that you're saving for, you're going to buy a house in a couple of years, you've got a big purchase that you know is coming up. You don't necessarily want to expose that money to stock market risk because you have no control. Markets might fall 20% over the next couple of months. And if the markets fall and you need that cash out of your portfolio, then you're in pretty big trouble. That's why a lot of people, financial advisors, will tend to recommend having 3 to 6 months-ish of cash as your emergency fund. And then only once you have that kind of buffer of cash built up, then that's when you start thinking about investing. You don't want to hold too much in cash, obviously, because over the long run, cash loses value in real terms against inflation. We've seen that really clearly over the last few years in particular. But investing, on the other hand, is much more for your long-term money, where you have time to ride out the stock market ups and downs. So if you don't need the money for 30 years, then it doesn't really matter if the market falls 20% over the next couple of months because you got 30 years for the stock market to recover. So yes, coming back to those rule changes that you mentioned, people under 65 obviously will have that £12,000 cash ISA subscription limit coming down from 20. So people have this who tend to contribute 20k to their cash ISA will now have this £8,000 worth. Think, what am I going to do with that? And it creates this kind of natural point at which they might ask themselves what that money is actually for. And actually, is cash the best place for it? Or should I be thinking about doing something else with it? Maybe I should invest it. I think it's probably also worth stressing that the rules aren't finalized yet. I think the consultation, the industry consultation, finished earlier this month. And we've now got this period from like now to next April where the new government will start thinking about, okay, what are they going to do with this regulation? Is it going to come into force as it was kind of drafted, or are they going to make any tweaks to it? So yeah, just with that caveat in mind.
I think, there's a really interesting little bit of detail in there as well where, and this is something that, because obviously not everyone's going to be filling 20 grand in a cash, in an ISA every year. The vast majority of people aren't. I think the average is something like maybe £8,000 to £10,000 a year, something like that. I looked at the numbers a while ago. I can't remember the specific detail, but it's something like that.
Yeah.
But there is a really interesting little detail in the new rules, which is cash held inside investment ISAs is now going to be subject to a charge, a 22% charge on uninvested cash. So there is a kind of a real tax liability moving forward for anybody who's maybe put their cash in the investment ISA, but hasn't actually done anything with it. There is going to potentially be a tax implication there. So that's something to keep in mind. The next thing here is, okay, so we've got money in the investment ISA, and we're thinking, what do we want to do next? I mean, I remember my journey into this, and I think, Andy, you described it well there. And this is kind of was my journey with it. And the first thing we were doing was we wanted to buy a house. So I didn't really actually, as much as I know that I'm supposed to be investing, I'm doing some of that through my pension, and that was the kind of core. But we were prioritizing a shorter term goal, which was saving for the house deposit. Once that was out of the way, then I started thinking about, okay, well, what can I be doing to invest a little bit each month, even if it's just sort of a £50 contribution or a £100 contribution, start that process. And I made, think perhaps overeducated, poor choices. I think Andy's probably the best way of describing it. I started doing funny things like buying British small business investment trusts and smaller companies and that kind of thing. And some of it didn't really do very well. And I ended up having to bite the bullet on a couple of things and actually switch out and just, stuff that I probably shouldn't have been doing as a starting point. And I think I kind of learned from that experience. But there is also an element of me being a little bit, spending too much time looking at my portfolio. Maybe I should have left it alone and just kind of had a bit more conviction in what I was doing. But I think the point here is you've got to kind of start with a top level view of, okay, well, what do I want my investments to do over the long term? What are the areas of the world where this is, where I think that there is going to be success in in investing, and then actually being happy enough to leave it, forget it. Or in fact, just saying, I don't really know enough about this, so I'm just going to do something that is a bit of everything.
Yeah.
Do you think, how would you kind of frame that approach for people who are kind of looking at this for the first time?
So I think you're absolutely right. Most people get into investing in a way like you do. Right.
Yeah.
They start punting, they buy crypto, they buy meme stocks, they buy individual shares because that's fun, right? That people, people that have made a lot of money by doing that. And you think, oh, maybe I'll give it a go, give it a punt. And everybody does it. It's such a common way for people to start investing. And part of me thinks it's inevitable. Part of me, so the answer that I'm going to give is like the very nice textbook. Okay, this in an ideal world, you haven't invested before. This is how you go about building your portfolio. But in reality, I think it's not as quite straightforward as that because most people will already have had some experience in investing. They will have made the mistakes that you've made and they've come around and they've realized that actually investing in individual stocks or crypto or meme stocks, whatever you're buying, it's really hard to make wealth grow over the long term by doing that because it's such a low probability of success endeavor over an investing lifetime. And I don't think there's anything wrong with it. I think it's a great way to get people to learn about markets and investing because one of the most correct ways to do investing is for it to be quite boring and dull. And that's not exciting and it doesn't get people to start investing. What does get people is the thrill of, oh my God, I could double my money in 6 months because I bought this amazing individual stock or crypto or whatever it is. Now, obviously it doesn't always end up like that, but it gets people thinking about risk and return and diversification and maybe short-term thinking isn't the way to go. Maybe candlestick charts aren't the best thing in the world. Maybe actually the way to do it is to be low cost and long-term and diversified. And over time, people, I think naturally, through their own mistakes, which are inevitable, gravitate towards the low-cost, long-term investing philosophy, which is kind of what InvestEngine was built as a company to cater for. So all that aside, I think if you are kind of now, maybe you've got to the point where you've made those mistakes, you've bought your individual stocks and you're thinking, what do I do now? Or hopefully you haven't actually made those mistakes yet and you're coming fresh, you've got this 8 grand of your extra cash or whatever that you're looking to invest. The first thing I think to do is to probably take a step back. Most people don't put the work in upfront before they invest. There's a really good quote, which I often think about when I'm making portfolio management decisions, which is that all battles are won or lost before the first shot is even fired, right? I can't remember who said that, Napoleon or Sun Tzu or somebody. And it's like, it's really accurate here because so much of your investing journey and your success or failure and experience comes down to the decisions that you make before you invest, right? Once you've bought your ETFs or your funds or something, then you're committed, right? Then your kind of future mistakes the seeds have already been sown. So I think taking a step back before you invest is actually really important and think about a few things. So number one, you need to decide how much risk is appropriate for you. What are you actually investing for? Is it retirement in 30 years? Is it a house deposit? Is it university fees for your child or something? That gives you your time horizon. And the longer your time horizon is, generally the greater your capacity is for tolerating market falls because, as we've said, you have more time to recover. If you need the money immediately, then yes, your capacity to tolerate those market forces is much lower and you should be on the low risk end of the spectrum. And that's what it's all about, is determining your risk tolerance. And a big part of that, as well as your time horizon, is your mentality, your personality, your ability to deal with investment losses. And some people are just wired differently. I might say I'm perfectly relaxed about seeing my portfolio fall like 30%. That is my personal tolerance for risk, as an example. Everybody's different. You might be happy with 50%, or given your history of stock picking, it might be 75%. I don't know.
No, not that. Definitely not that.
And generally, the lower risk that you take, the lower you're happy seeing your portfolio fall, the lower return you're going to be able to get over the long term. And everybody will fall somewhere between extremely high risk, willing to tolerate large losses, and extremely low risk, not really willing to tolerate losses at all. So I think the first thing is to think about how much you're willing to see your portfolio fall in value, what your investment goals are, what your time horizon is, and that will put you somewhere on that spectrum. And yes, age matters. I think it's quite like a blunt rule that a lot of people use of like your age in bonds, or like just figuring out if you're young, you should be invested in a high risk portfolio. But I think there's a little bit more nuance to that, both in terms of what the individual investor's personality is like, but also what is that pot of money for, right? A 30-year-old might have a 2-year time horizon for their house deposit. Now, yes, they're young, but they shouldn't be in all equity because their time horizon is very short. And similarly, someone who's 65 but has a really secure state pension, or if they're lucky enough to have a DB pension from their employment pension scheme, they might be investing for the next generation, in which case their time horizon's ages. So they don't necessarily need to be in really low risk portfolio, which traditional kind of lifestyling would imply. So step one, I think, is actually before you invest, take a step back, think about your risk, think about time horizon, think about what kind of person you are and how and where on that kind of spectrum of high risk to low risk you're going to sit. Because what that determines is the next step of your investing journey, which is your asset allocation, right? Translating that risk profile into an actual broad split between risky stuff and safe stuff in your portfolio. So when I say risky stuff and safe stuff, that's equities and bonds is technically the kind of the simplest way usually to describe it. There are other interesting and cool asset classes. I understand you've done lots of material on gold, but equities and bonds, equities, the risky bit, they're the ownership in businesses, also called stocks and shares. They've got high returns over the long run, but they're high risk. They tend to fall more than bonds do. Bonds, on the other hand, they're safer, much lower risk. When you're investing in a bond, you're not participating in the equity ownership of companies. You are lending money, usually to a government or a really high credit rated company. And they've got low risk, low returns than bonds. So the kind of split between equities, the risky bit, and bonds, the safe bit, is determined by your step one, which is where do you sit on that risk spectrum. And then once you got to that point, you say, okay, I now know where I sit. I now know I should be either in mostly equities because I'm in high risk, or I'm mostly in bonds because I'm low risk. What do I actually do? Like, what do I log on to InvestEngine or other platforms available and put in my portfolio? And that, I think, is where a lot of people struggle. I think it's because it's overwhelming. There are just so many different, not only ETFs out there. My answer is obviously going to focus on ETFs because InvestEngine is an ETF platform, but it's just baffling. There are dozens of platforms and thousands of different possible securities you can invest in, let alone just the choice within ETFs, which is just one type of vehicle.
Let's pick up on that ETFs point, because I think that's interesting. So when people come to invest and they pick their platform, as you say, InvestEngine is an ETFs first platform. These are essentially different kinds of investment vehicles that we can pick using through our investment ISAs, and that those vehicles will then invest in certain areas like the US or globally or in particular areas. And the kind of two main ones that I think most people watching this will be interested in looking at will be funds, and then within that probably index funds. But then ETFs are a slightly newer form of, I mean, they're ostensibly similar in the way that they work in terms of investing, but there are some nuances, aren't there? I mean, I'll give you my personal anecdote on this, which is actually an embarrassingly recent one, given how much time I spent talking about this. I actually set up a couple of junior ISAs for my sons recently, and I managed to accidentally invest them in essentially the same fund by the same provider, but one was the ETF version and one was the fund version. So I'm conducting a sort of accidental experiment between my two sons to see if there's any difference between the two, which might come down to charges. I actually do need to go back and check that at some point. But let's talk about that difference there, because there is a difference and there is potential consequences or benefits to that.
Yeah, I guess I'm not sure what the kind of level of experience of your viewers / listeners is, but just to kind of take a step back to make sure everyone's included in the conversation. I apologize actually for the jargon in the finance industry. It's really annoying. There's way too much of it everywhere. It does make it quite impenetrable for someone who doesn't have the kind of background of investing. ETF, it stands for Exchange Traded Fund, and kind of unpicking the name a little bit, there are clues in the name as to what it does. So it's a fund, as you say, similar to the funds it sounds like you've invested in, which in the US are called mutual funds. In the UK are called OICs, open-ended investment companies. Exchange traded means that it's traded on an exchange. So it's very similar to a traditional kind of mutual fund structure. It's a basket which you can have lots of different things in that basket. So your basket, your fund could have only American companies or only UK companies or AI companies or healthcare companies. And it could put thousands of different companies into that basket. So we have, for example, a popular ETF on the InvestEngine platform, a global ETFs, which track the global stock market. And that holds companies from all over the world, thousands of different companies in that one fund. So the price of that fund, the ETF, will move with the value of all the different companies all over the world, which is a big benefit because, as we were talking about earlier, picking stocks is really hard and it's really risky and it can get really expensive with all the fees baked in there. So you buy one ETF, the kind of one of the many benefits of ETFs is you buy one ETF and it gives you kind of instant diversification because it holds all these different thousands of investments inside it. And obviously, it doesn't just have to be stocks. There can be bonds, there can be gold, there can be a mix of them. Like there's all sorts of different interesting and fun things you could put in ETFs. But one of the main differences versus traditional OICs, mutual funds, is that you can buy and sell them on platforms whenever you want because they trade like a single share. They trade on the London Stock Exchange. So that's one benefit is you can buy and sell them whenever you like, as opposed to a fund where you can only trade once a day. And the other benefit, which I think is quite underrated, is that they're much more transparent than traditional mutual funds. So with mutual funds, you only get the holdings usually once a month when the fund manager reports the holdings. Whereas with ETFs, it's constant. It's every day. They're always updated.
Interesting.
And that's really useful because we have this like really cool bit of tech. I don't want to tend to like a product plug or whatever, but it's a good illustration of my point. We have this tool on InvestEngine called Portfolio Look Through, where you can, before you buy an ETF, or actually even when it's included in your portfolio, you can have a look at what's included in the ETF, i.e. what stocks or bonds or whatever does this ETF hold, in what percentages, what does that mean for the regional exposure, what does that mean for the sector exposure? And that's super useful because you can then blend that with your existing portfolio. So let's say you have 4 or 5 different ETFs which cover different regions, different asset classes, different sectors. You can view that as one consolidated portfolio and say, okay, it looks like because I've got these 4 or 5 different ETFs, I'm actually really overly exposed to UK because I bought too many FTSE 100 ETFs, or my allocation to the FTSE 100 is too high, for example. And that's really useful. And that look-through functionality allows you to aggregate the information from loads of different ETFs to present it in one kind of consolidated, aggregated way, which you can't really do with mutual funds because the kind of reporting is so much less frequent and they're just not as transparent. So
that's really interesting. That's something I've never actually really realized about ETFs with that. And that's always been a bit of a something a bit that has annoyed me about that kind of that mutual fund structure, where a lot of the time you'll just get a look at maybe the top 10 holdings in what they're doing, particularly with funds that are actively managed by, where the decisions are effectively made by a human fund manager, as opposed to an index fund where you are just buying a whole index like the FTSE, like the S&P 500. And there's also an interesting thing in there as well, because, and this is something we talk about a little bit with kind of global trackers and perhaps being exposed to places like the US and even to kind of AI and that sort of stuff. So that transparency could potentially be really useful, but I guess there's probably a little bit more digging down into that could, I think, with a bit of research, maybe learning about it. But, you know, we're kind of looking at it as we go. I think that brings us to, because this is the thing, right, is we can talk around this a lot and give people kind of general suggestions about what they should be looking at and ideas. I think, generally speaking, you know, we don't want to tell people go and invest in this or you should be buying that. It really is up to people to make their own informed choices when it comes to that sort of thing. And obviously, as we've said before, it all carries risk. So you might invest in stuff that goes down and doesn't necessarily go up. That is something that you have to deal with in investing. That being said, I know InvestEngine does publish some really interesting regular pieces on what actually people on your platform are buying. And I think that could give a really good indication, right, of what actually normal people are doing with their investment. So I know there's I had a look at the list of the kind of top 5, and I looked at also the first 6 months of this year, and then there was also one for July, and actually they were more or less matching in terms of what was there. So what struck me was this about these lists. The top 3 were the number 1 most popular in the UK so far this year was an S&P 500 index tracker. So that's obviously reflects the popularity of the American market would be my estimation. Below that were 2 kind of all-world index trackers. So that's people who are saying, I don't want to pick something specific, a specific region. I'm just going to invest in the whole world. And then you go a little bit further down, and this is where my kind of my hobby horse of gold comes in. Gold is in that top 5, which I found very interesting that gold's in that top 5. And then the number 5 on the list was an emerging markets in tracker, I think it was, wasn't it? So those, sorry, I've chucked a few different things at you there, Andy, but what are those choices and that people are making tell us?
Yeah.
What can we infer from it?
So I guess headline, from my read of this at least, it's pretty encouraging. The top 3, as you mentioned, there was an S&P ETF and then 2 FTSE All-World ETFs. And those are really like quite broad, diversified indices. So you might think that with what's going on in the financial media about AI, individual technology shares, geopolitics, interest rates, you might think that a lot of people are buying flavor of the month, which ETF's doing really well is the AI ETFs, cybersecurity, I don't know, healthcare, biotech, really like niche ETFs, because the smaller niche ETFs do tend to be more volatile and have those periods of really quite pronounced outperformance. But actually, despite all the noise that's going on in markets at the moment, people are still buying sensible options. They're buying all-world trackers. S&P trackers, okay, I understand it's like a really popular index and it is kind of like the default for lots of retail or individual investors. But it's probably worth me highlighting that the S&P is not a kind of neutral global allocation. You're making quite an active bet if you're using the S&P as the entirety of your equity exposure, because you're just betting on the US. Now, whether that's right or wrong, I mean, you might genuinely think that the US is going to outperform over the long run. But what I worry about is that lots of investors don't really think about that, and they stick everything in an S&P tracker and don't really realize that they're investing in only one stock market and in only one currency, importantly as well. So when the US underperforms, which it will eventually, markets always go in cycles, or the dollar weakens, then their portfolio is going to be hit really hard relative to a more diversified global equity asset allocation, which you might get from one of the 2 global trackers that are in the top 3, which is the all-world ETFs.
Yeah.
So kind of more generally, I think it's a good trend. I think people are being sensible and they're buying kind of diversified ETFs. And then, as you say, as you go down the list, it starts to get a little bit more thematic. You have gold in there, emerging markets, small cap, I think, is also in the top 10, which I think is absolutely fine, right? What I tend to say is that like having a small part of your portfolio to have those active bets, those more risky, punty, kind of fun money, absolutely fine. I have no problem with that all the time, manage my own money. And I think scratching that kind of fun itch of like, okay, this could do really, really well over the next 6 to 12 months in the short term is totally fine. We're all human. It's fine. But as long as you have 90% of your portfolio in the really boring, long-term, low-cost compounders, the FTSE All-Worlds, a diversified portfolio that suits your risk profile, then I've got no problem with sticking that in whatever the hell you want.
Yeah, look, you're speaking to somebody who has probably a non-negligible amount of a gold ETF in one of his investment pots. What that highlights for me really is there's kind of like, it's the diversification point. So if we diversify our investments, we can make these choices, but actually you don't have to just find one and pick it. Yeah. You can have a few different. And then the decision in that then becomes, well, how do I balance these against each other? Maybe I want to have half of what I'm doing a month going into the global. And then maybe gold just needs to be maybe a 5% piece of that. And then you're kind of balancing those risks a little bit against each other. Or something like the emerging markets one, which is naturally more risky, but there is also a greater potential opportunity for growth there that can add obviously another dimension to it. So I think these are all really like important things to think about I think it's obviously something that's your own choice. I'm super keen to hear from anybody who's been following along today. What goes into your investment decision making? Has this helped at all? What is in your kind of thought process on that? Are you just getting started? We really love to keep the conversation going in the comments and hear from you about all of this, because I think it's an area where I think, Andy, we could probably have gotten into quite a lot more. When you mentioned currency risk and that kind of thing, I started thinking, well, that's a podcast episode in itself, quite possibly. There's lots of other strands to this, but we wanted to try and encapsulate the kind of the nuts and bolts, getting to grips with the very basics of it. So I think that pretty much draws us to a close. Andy, I'm going to say thank you. It's been a pleasure to have you on.
Thank you for having me. It's been great.
Brilliant. And thank you everybody for following us. Give us a subscribe, because we do all this kind of stuff on a weekly basis. With that, I shall say thank you everybody, and goodbye.